This is a Momentum Media production.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Welcome back to another episode of the Property Nerds podcast. I am your host for today, Arjun Paliwal. And today, I'm going to be doing things a little bit different. Essentially, we don't have my lovely co-host, Lee Paliwal, on today. She, unfortunately, and our little one, Ruby, are feeling a little bit unwell and definitely, needing a bit of rest. So I'm going to be doing it solo, which I can't recall, but I don't think I've done a solo episode on the Property Nerds show before. I've done them, obviously, and I do them solo, typically on the Investigate podcast. But this could be a first on the Property Nerds show because I do recall, I think almost everyone, I'm with someone on the show, but if not, and I was wrong, well, you've got me again. So I wanted to talk about today's episode in great detail because today's episode, we're not going to go through just a bit of typical news or what's hot at the moment. We're going to peel the layers back and actually walk through what our cycle analysis and categorization procedure is at Investigate Buyers Agency. We're pulling off a layer and going to show you today how and what cycles are, in our opinion, and how we come up with them and what are they in terms of the different positions. And I'm going to be showing you, talking through this today, how we actually have used this way of analyzing markets in order to come up with positionings of cities. Now, when you say positioning of a city, or when I say that, what I mean is, how is it that I'm able to say that this market is going to do X? Or how am I able to say that this market is not quite ready for growth? Or I expect this to perhaps do well over the next year, maybe not do so well over the next year and then come back around. So we're not talking about the data or percentage of indicators and their strength for a certain area. We're talking about the whole city's cycle position. We're talking about how we get to it and going deep into the different categories I have to label them. This, what I'm going to go through today, is the formula that has helped us scale many portfolios to A, being diverse, B, being of a significant size in both purchase value and purchased properties, and then C, actually outperform the Australian housing market. And this has been done time and time again since we started Investigate 6 years ago, and it's helped us produce the client results that have enabled our clients to help us actually back by winning the award for Buyers Agency of the Year 2024 and also back-to-back in 2023. So I'm going to reveal all in this particular episode just so you can truly understand the right way to analyze housing markets and their positioning. So let's get into it. The first one here is to understand what we call these labels. I use 3 different phases of markets in terms of their cycles. This is not the property clock. This is not a perfectly aligned clock that goes up and down, or round and round, should I say. This is 3 distinct phases. So the first phase is called early adopter. And by its name, it's actually saying if you are coming early to these trends, you're adopting these trends, you're adopting, investing into the city before every single one else or everyone else has thoughts in their mind to consider the city. You are beating the pack. You're early. And in this podcast episode, I'm actually not just going to reveal what they are, but I'm actually going to reveal a city for each one so you know where they're placed and you actually get a city out of this analysis. So that's the early adopter. Now, before I break it down further, I'll explain the next 2. The next one is everyone's favorite words, the hot spot. This is where growth is very strong and likely to remain strong. And it's also creating a lot of growth, not just over a year or 2, but potentially days, weeks, and months, the growth is happening. Then the third one is called a second wind. Now, the second wind has 2 halves to it. One half of the second wind where you're buying and there's a dip in play. So your negotiation strengths are extremely strong. And then second is there is an uptick, that second wind, right? As the runners call it. the second wind there is allowing you to get that second surge of capital growth. So now you know the three phases. We're going to go through and talk about how each of these phases is placed in its position and what indicators specifically are we looking at to say that something is there. Alongside this, I'll break down their pros and cons in more detail as well. Okay? So when it comes to early adopter markets, their growth rates have been weak over the last decade. And when I say weak, you can take this in multiple ways. You can say weak in comparison to that city's long-term average, and you can say weak in comparison to other markets in the nation over that same time period. So to give you an example, if we take an early adopter of the past, I'll take you through to Adelaide and Brisbane in 2018 and 2019. If you took the capital growth rates for the 10 years prior to those 2 points, and even Perth you can throw into there, but these three cities, they're extremely weak. Like if you compared them to their long-term averages, they were below. And if you compared them to the rest of the nation in terms of, say, other major cities in the same bucket, Sydney and Melbourne, they were well below. So the first thing we're looking here is periods of underperformance. And the key here is that the belief of markets returning back to their long-term average, and it can do so in many ways. A, through sheer demand for what that market is producing, whether it be jobs, whether it be an undersupply coming up soon, and that then causes that net demand, or whether it be, just finance take up in general across the nation, but then that happens to be more affordable. And so when people are taking up more finance and it's more affordable there, that gets to have more love. But it can also be from the perspective of that market itself just being better value in comparison to other cities. And so what we can look at it as many ways. The main thing, though, is people are seeing it as better value potentially, or there is demand that hasn't been there that now is being there. And that's that change we're looking for that eventually starts showing in the data trends. But the first prominent piece of an early adopter is that it's very poor in performance in recent years, extended out for a longer period of years. 3 become 5, 5 becomes 7. And when you're hovering around that 7 to 10, suddenly you're like, hey, this is a market that I want to keep an eye out on, because surely it can't be doing this forever. Now, again, though, just because it's been low performance, you can't just assume that suddenly it must perform. Something's got to change. Okay? Because what if you're that investor at year 3 of 10 years of underperformance, but you're at year 3 saying, hey, the last 2 are weak? What if you're in year 6, the last 6 are weak? That's still, for the 3-year investor, 7 more years of pain. And as a 6-year investor, another 4 years of pain. So just because it's weak, we don't want that to be the reason alone. We want to see some sort of change. Doesn't have to change too much, because if you wait for that, you're probably too late. But that's just an example. Now we're going to go to the hotspot. For the hotspot, you're likely either A, rapidly catching up to long-term averages due to short-term growth being very high. And an example of that is now we've started to see Perth and Townsville have really, really good growth. So I told you I'd give away some locations. And I'll actually give you some more locations in the early adopter too. But Perth and Townsville are an example. Adelaide is an example. Toowoomba is another example. Bunbury is another example. Bundaberg, and the list could go on. The main thing here is that these markets are just some of many that have displayed either A, above long-term average capital growth rates in recent years, signaling a boom that's carried the 10-year growth rates above long-term averages, or B, the long-term growth rates are still below average in terms of the 10-year point, but the 1, 2, 3 is really, really strong, and it's eventually going to catch up to that trend line, but it's very, very strong. All of these cities are carrying usually growth rates or growth rates expected of double-digit percentages, especially in recent times. Even 8% above is considered a hotspot. So from this perspective, you don't have to double-check an indicator to know if it's growing. It just is. You can tell by the people at the open homes. You can tell by the speed of how fast properties go. You can also tell by when you miss out and the frequency of you missing out. You can also tell by how much you have to index your comparable sales out to capture the missing growth from last 6 months sales because 6 months ago is now too old on the comparable list. These are all some signals. And you can also just use recent 1, 2, 3-year trends to show that the sales volumes, to show that the price growth are all in places that are much better than what was expected of this place or has happened in the past. Then we have second wind. I said to you earlier that there was 2 phases for second wind. The first one is when you've seen some growth that has been above long-term averages, and then it dips down. An example of this is Bendigo and Wodonga. Bendigo in recent times saw a really good boom in that sort of 2017 to 2022. And during that time, the growth rates were above their long-term averages. However, between 2022 and 2024, the growth rate started to dip. There was a bit of a decline. With that decline, we're looking for signals that suggest it's starting to turn. And with those signals, you're seeing that it's not started the turn yet, but it's starting. And that starting piece is still in an area where you're able to go and say, I want to negotiate great deals. I want great buying power. I want to be able to have more stock and more choice. I want to make a controlled decision, and I want to choose the best looking and feeling home whilst I'm negotiating heavy and whilst I'm getting that controlled decision. There are upsides there, right? The downside is you're in that dip phase of a second wind market. I would not expect immediate or some substantial short-term growth. I just wouldn't. You're setting yourself up for it, though, when that cycle comes back around. Now, what's an example of the second phase of the second wind, where something's come back around? As a simple and free exercise, I want to visualize this example for you. Go to SQM Research, look at total property listings, and look at the city of Brisbane. And what you'll notice in 2022 and 2023 was the listings, firstly from COVID, coming down to that point. And then there was a lift up, and then it went back down again. That lift up happened to also be some of the slowest periods of growth in Brisbane in that recent boom. Took a short breath, and then it came back up again. Those 6 to 12 months was a point where Brisbane was in this first phase of second wind, where it had the indicators to say, look, it might pop back up again, but listings have picked up, confidence is stripped out of the market, and it seems like a great negotiating time. And it was for many that invested there during that time. And then in 2024, listings tightened again, and all of a sudden, the demand indicators came back, and Brisbane's growing again. It's now in that second phase of second wind. That breather, that step back, and growth again. Now, that second phase of second wind, you can't expect it to keep outperforming its averages forever. Because remember, it's already had a cycle run that's put it beyond its 10-year averages. However, it's just something to note that the conditions are still there for some really healthy growth. Gold Coast is another example of a market here. So these are now the more cycle positioning factors. And I told you I'd come back to early adopters to share an example of a market in early phase, and I can walk you through it. So in 2020 and 2021, we identified Townsville, Rockhampton as early adopter phases. And those 2 markets really have done brilliantly since our predictions back then. Today, you can start to see Melbourne display some of those signs. You could half say it's still a little early, but it depends on what your portfolio is after and what you feel it needs. But right now, it is an early market. The first signal is that it's had 7 years of little to no growth. Sure, there was that little COVID jump in between, but if you really take it from its peak price rate at 2016-17, it hasn't done much since. In fact, I'd be here saying that you've really had poor performance if you purchased a house in Melbourne 2017-18 odd. Since then, the growth rates wouldn't have been that great. As a result, it's starting to turn from a 3 to a 5 to a 6 to now 7 years of that trend line. You're a couple of years away from low performance to basically say that you're now reaching a 10-year performance that is quite weak in comparison to all its counterparts and its own long-term averages. So firstly, I've highlighted it could still be a little bit before the growth kicks in, but at the same time, it's well before in terms of the cycle that everyone else would probably want to enter at, which is when people typically enter when everything's cruisy and everything's rising and everything looks great. Another thing on the early adopter now is actual indicators we look at. So here are the things that we see. Firstly, we see economic activity recovering. Because when economies lead the recovery through infrastructure spend per capita, job advertisements, unemployment rate, and confidence, we start to see the rejuvenation of an area. I'll give you a case study here. In Townsville, when we saw that it was an early adopter, we saw that its actual unemployment rate started falling heavily from about 10% in 2016, and it kept going lower and lower and lower, reaching near 3% in just the last few years. Now it's under 3%. So from that perspective, Townsville had a huge reduction in unemployment, an increase in infrastructure spend, and that too spend per capita, lack of growth over the 10 years, an increase in job advertisements, and also improved confidence. So that's clear signs of that economic play. The next is usually what happens after a huge amount of growth and then a fall off of growth is building oversupply turns to undersupply. Building supply in terms of future supply, using approvals, using completions, starts, all of these things start to have a seesaw outlook on them. One, then the other, one, then the other. And Rockhampton is a great case, again, when we factored it in our early adopter cycle. Around the same time, 2020-21, Rockhampton saw a huge amount of building approvals from 2011 to about 2014. That huge oversupply was coupled with a shift in its local economic landscape. Prices then followed to be extremely weak for many years. Now, when you have extremely weak prices for many years, what's going to get someone excited to construct a whole bunch of houses there? How they're going to think of the end product, end consumer, and selling that. But when price growth is really strong, jobs are really strong, and confidence is high, that motivates people to land bank, grab land, see that land appreciate, and then eventually build on it, have approvals, starts and completions, and then all of a sudden, supply meets the market. So in this case, we're looking for that weak economy that's turning. And then now we're looking for a huge building approval run that came down to be a very low approval run. And that's an example of the two coupled indicators together. Melbourne as well, just to come back to that point. Yes, it has some areas with heightened building approvals, but at the same time, Melbourne as a city has an extreme low building approvals in comparison to its big oversupply push between 2012 and 2017. And so from that perspective, the lag of that happened over the many years, whereas now, while some areas still have high percentages, the overall city is definitely much lower than where it should be and probably going to be much lower for some time. And so then we move to the next curve out of the spider chart that we've created for this, which is our established supply. Established supply, we don't see it be very low because if it was so low in an early market, then guess what? It's no longer an early market. It's quite hot. Because remember, low supply means high growth. And so if we're seeing low established supply, low housing inventory, it's likely the demand to supply curve is already in action and motion. So when markets, before they kick into growth phases, there's usually a good level of online supply for sale. And that's where the people who do come in early have greater negotiating. So both from a stock on market, from a inventory, and from listings, both in terms of 5-year trend lines and current availability, they're usually not super crash, hot or low, and they're not crazily oversupplied because how long are we going to wait for the turn? They're probably just a little mildly oversupplied. And this is where the buyers come in and so-called clean up, right? That's from, say, an investor view. From owner occupiers, they snag better deals. This is just an example of what can happen. Now, rental pressure. Rental pressure is the next one. I never want the rental pressure to be low. Because if the rental pressure is low, how can you feel confident in the supply dynamics shifting and you're now waiting for a new cycle to emerge, all whilst you're getting crushed on cash flow, crushed on the ability to hold it, and your fingers crossing? That's just speculation at its finest. We've got to understand that we need to eliminate speculation of true housing demand. And true housing demand sits in the rental market, which is where people are going, I'm not speculating about living in the city. I have no options to live in the city. This is where I have to live because this is where the rent is. I don't have 20 houses available for me for rent or high vacancy rates where I can pick where I choose and decide to move in or not. No, I want to live here and there's not much available. So that to me has no speculation. People aren't going to a rental open home and saying, wow, wonderful property. Can't wait till my landlord increases the property rent here by $50. So we want to see tight vacancy and we also want to see yields improving. And this is really critical. Yields improving have a domino effect. Now, this domino effect isn't perfect in nature, but it can be something helpful as an additional indicator. When we start to see yields rise, it can make flow-on things happen. Number one, it can attract investors because they like the return in an area. Whether that's great on a benchmark against other cities or whether that's great benchmarked on its own, it's going to be dependent to each investor. Number two is as that yield is rising, not only are investors attracted, but in renters that do want to, because not all do, but the renters that do want to shift to the buy side of the equation are now suddenly going, hold on a minute, like, this is annoying. I really want to not rent here. They moved me up from 600 to 700, 700 to 800. And yes, sure, they can go out the rings or they can keep going further out and further up in the sky in apartments, but eventually they want to consider their options. And not a huge group, because some renters will stay renters, some renters will like it for the lifestyle, some rentals will prefer it because of its convenience and other factors, but then some will go, well, I don't want to keep doing this. I want to try and find and buy a place. And to them, it's now not as overwhelming because the price pressure or the cycle has not been huge. It hasn't been booming away for them in their local city. So they might still have a chance to buy something as well. So this dynamic of investors starting to return, this dynamic of renters buying, and then you have the third group of upsizers, downsizers start to realize something's moving and they don't want to miss out. They start playing along. And that eventually turns to price pressure. Price pressure is the fun metrics. This is like inventory levels, days on market, so speed to sell, vendor discounting, auction clearance rates, actual sales volume movements, and also asking price movements. We're looking at all of these factors together with their individual weightings, and we're seeing, is the pressure high for short-term growth? And we essentially don't want it to be super high, but we want it to be higher than what we've seen in the past. Because remember, you want something to change. You want the economy to be improving. You want future supply to be low or lowish. You want established supply to be okay. You want housing availability to be okay. You want rental pressure, I think I mentioned already, to be strong. And then price pressure to be okay, not like you've missed out a lot, but better than the past. And I've given you a few examples of previous case studies of cities we've invested in, called out in the media, seen their increases, and had clients purchase there before. Now over to the hotspot. The core difference here in the hotspot is price pressure's high, future supply starting to change. Because remember, the developers and everyone wants to get in on building and starting to approve dwellings, land bank. So eventually that forecast of growth rates is going to change eventually. Housing availability super tight, undersupplied, listings undersupplied, inventories very low. We're now talking all the indicators are peaking in terms of low supply everywhere, competition on properties very high, rental pressure still strong with low vacancy rates, and price pressure, the core indicator, showing some strength. So this is where the high confidence for short-term growth is a pro, but the con is intense competition. And that's another thing I should touch on. With the early adopter, let me quickly give you a pro and con. The pro is you get full exposure to a market cycle and you negotiate extremely well. The con is, could you be perhaps a little bit too early because you're just relying on some trends to change? You just need a bit of patience. Now, the hotspot's pro is high confidence short-term growth. Like, you can't tell me something's not going to grow if 50 people missed out on that property and you happen to get it. Where do you think the 49 people will go next? And you're that 50th person that got it. That 49 group of people will basically go on to the next one and have to fight that little bit harder. They're not going to go just pack up and go home and go, alrighty, we'll call that a day. I'm done for house hunting for now and maybe next year. That is not how it works. Capital growth happens in competition. Capital growth does not happen in the absence of competition. So it's important to recognize that if you want growth, you have to compete. That's what happens. But if you want to get there early, have a bit of patience, then the early adopter wins on that part. Now, with hotspots though, those are the core indicators. And I gave you a few examples of some markets today. Like today, there are many in this category. More of the countries in this category than in some other locations or other positions. I gave you some locations for second wind, but typically what I've found with second winds that starts the conversation again is usually the yields uptick again. So we noticed the yields upticking substantially in Bendigo and Wodonga as an example. So that could be a sign of something coming up ahead because they moved their yields up 0.5% in the last 12 months, which is pretty crazy. Like imagine a city, let's just say any other city that was 5%, suddenly in a year it's 5.5% yields. Like someone's going to be keeping an eye on that eventually. But that's just an example of some starts of second winds. Then you have that new price growth emerge, inventory trend back down, days on market trend back down, vendor discounting trend back down, and that's that second phase of second wind. It's truly starting again. These are the ways we've identified market positions. Your goal is not to look at this and go, I just want to go to the hotspots. Your goal should be looking at this and go, wow, there are actual ways here to position markets in cycles. Why don't you take this information, rewind it back, play it through, and realize that you can go on a journey of positioning markets in their respective cycles out of these three positions. Make your positions. And then start to realize with your portfolio what's needed. Because too often people just chase the hotspot every single time for short-term growth. But I've seen positions where I've gone, hey, hold on a minute. You've got 3 properties in the hotspot. Everything is in that same phase of growth rates, cycle position. If you get the next one, sure, you're going to unlock some great short-term capital growth. That's it. If you want that, go for it. But when things slow down, eventually in these phases of markets, everything in your portfolio is slowing down. And then you'll have to stay idle. And this is something my wife and I made a really conscious decision of. We intentionally aren't going to pick the best growing markets every single time, all the time. We're going to pick a combination of the best growing markets for now, things that are coming off and likely to recover again because we can buy great and diversify, and then things that haven't started and we can remain patient whilst other things grow for us. That to me is holistically building a portfolio with an enhanced knowledge base across different cycle positions to make sure that almost every year of your holdings, you're going to be able to look back, look at your portfolio and say something's growing somewhere. And that's probably been one of the most powerful things in our learning journey over the last 9 years of investing. So that over the last 9 years, there has not been a year in our portfolio where I can't pick something and say I would like equity out of that. That is what I wish to come from this learning for everyone tuning in today, which is where you've really understood the way we've defined cycle positions. Throw out the property clocks. No more property clocks. Because it's confusing as hell. 12 to 3, 3 to 6, 6 to 9, back to 6, back to 3, back to 9 again. Someone's at 12, they scare you off and it's a peak. Then all of a sudden you look at their reports and you go, I've been looking at this for the last 2 years and you've said it's peaked for the last 2 years. How is it still peaking? That's not what you want. How can something keep peaking for 2 years? That's just a misalignment and a false prediction of you saying that it's a peak. Like, you don't want to use clocks. They're broken. Use cycle positions through categorization. Categorization is what we call it. And so we categorize them in these 3 categories. Early adopter, before, likely to grow, be patient. Hotspot, growth is high right now. Competition is high too. Second wind, 2 phases. Negotiating phase, good buying. It'll pick back up again, but don't expect the boom to last forever, but it'll pick back up again. Wait for diversifying a portfolio. And then the second part of the second wind phase, it's going off again, round 2. Grab what you can from it. I really hope this episode helps you understand A, cycle positioning, B, the way to look at them and the signs that show up that represent their positioning, and C, the indicators that we look at, the pros and cons of each phase, and then it allows you to go back to your drawing board and figure out what's best for you. Now, if listening to this all, you've really understood it, appreciated it, or even perhaps you're like, no, this is great, but it's not for me to figure out, we're just one call away, and that's investikit.com.au, and you can request a free consultation with us to see if we are able to help. And then from there, we can take this learning, take all the positioning of Australia that we know where things are at, and we've been getting right for so many years, and help you to grow your portfolio faster. That's it for me. Hope you enjoyed the solo run for myself here, Arjun Paliwal, Head of Research at InvestorKit Buyers Agency. And that's another episode from the Property Nerds.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.